Broadcast is now starting. All attendees are in listen-only mode.
Hi, good morning, everyone. Thank you all for joining us on this snowy day for our February webinar on required minimum distributions. For those of you who are joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth and have been with SCM for 4 years. My primary role includes client service, marketing, and compliance. I'd like to just start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will personally be monitoring all of them and will ask David to answer as many as we can at the end of the webinar. If we do happen to run low on time and we're unable to get to your questions, David or myself will reach out to you directly to make sure that we can get your question answered. Now I'd like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor, bringing with him over 20 years of experience in financial planning and wealth management. Prior to joining our firm, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He also continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. David also serves as a member on our firm's investment committee. Thank you, David, so much for joining us today.
Well, thank you, Amanda, and welcome everybody. Good morning. My name is David Juliano, Senior Financial Advisor with Stonehearth Capital Management, and we certainly appreciate all of you taking some time out of your day to join us for this month's webinar. As mentioned, we will be discussing required minimum distributions today, so we have a lot of great information to cover on this important topic, so let's jump right into it. So what are RMDs? Well, I like to think of RMDs as the IRS's way of saying to all of us, the party is over. You've enjoyed tax deferral growth in your retirement account for several years. Now it's time to take some distributions from those accounts and basically pay some taxes is the real reason why these RMDs are happening. So the tax deferral is a great deal. It's what makes IRAs and retirement plans so good. However, they were never really meant to be a tax-free investment forever. So these required minimum distributions is the IRS's way of saying, okay, the tax deferral party is over. Now we have to start to take some money out and pay some taxes. So what are RMDs? So that acronym stands for Required Minimum Distributions, sometimes referred to as Minimum Required Distributions or MRDs. So if you're doing some research or reading different things about this topic, you might see RMDs, you might see MRDs. We're all talking about the same thing. So it's the minimum amount that the federal government requires you to withdraw annually from IRAs and other employer-sponsored retirement plans after you reach the age of 70 and a half, or in some cases after you retire, and we'll get into the details of what that means. Now, you can always withdraw more than the minimum amount from your IRA or your retirement plan in any year, but if you withdraw less than the required minimum distribution, you'll be subject to a federal penalty, which is quite steep, and we'll take a couple of minutes later on in this presentation to go over what that penalty looks like. Now, the RMD rules are basically structured to calculate the distributions to spread out those withdrawals over the entire interest of your IRA or plan account over your lifetime. So the purpose of the RMD rules is to ensure that people don't just accumulate retirement accounts, defer taxation, and leave these retirement funds as a inheritance to the next generation. Instead, the RMDs generally have the effect of producing taxable income to you during your lifetime. So what plans are subject to these RMDs? We think of them as coming out of IRAs, and that's certainly probably the most popular account type where someone will be taking their RMDs. But RMDs are also subject to many different other types of accounts that you might have. So they apply to SEP IRAs, simple IRAs. They also apply to qualified retirement plans that people have from their work. So that would mean accounts such as 401ks, 403bs, 457b plans, and other types of profit sharing plans or defined contribution plans. So those are all kind of falling under the umbrella of qualified retirement plans that one would have through a employer-sponsored structure. So it's important to be aware that there are several account types that are captured by these RMD rules. Now, let's talk about Roth IRAs for a moment. An important distinction to be aware of as we discuss these account types that are subject to RMDs is how they are applied to Roth accounts. So RMDs are not required to be taken from a Roth IRA by the account owner while they are living. However, RMDs are required with a Roth 401k plan. So some of you that have made contributions to 401k plans while you're still working, there may be a Roth option within that 401k plan structure, meaning that you can make contributions on an after-tax basis to your 401k. Those are considered to be Roth 401ks. So the RMD rules do apply to Roth 401ks, even though they don't apply to Roth IRAs. So very important distinction in the Roth world. So it's easy to think that RMDs don't apply to all Roth accounts for the account owner, but as we can see, there is that one important distinction between Roth IRAs and Roth 401ks. So important to be aware of that. So we often get the question of when must RMDs be taken, and this really gets into a lot of the details about how these RMDs work. And your first required distribution from an IRA or a retirement plan is for the year that you reach age 70 and a half. However, you have some flexibility as to when you can actually take this first year distribution. The IRS allows an exemption for this first year distribution. You can take it during the year you reach 70 and a half, or you can delay that first RMD until April 1st of the following calendar year. So since that first distribution generally must be taken no later than April 1st following the year you reach 70 and a half, that April 1st date is known as your required beginning date. So this means if you opt to delay your first distribution until April 1st of the following year, you'll be required to take 2 distributions in that second year. Your first year's required distribution, and then your second year's required distribution. So if you do opt to take advantage of that delay, then you'll be bunching up 2 RMDs in that same year. The other option is just simply take your first RMD in the calendar year that you turn 70 and a half, and then just take the next RMD in the following year. After that, all RMDs in subsequent years must be taken by year end of each subsequent year. So remember, it's only that first RMD where the IRS allows you to wait until April 1st of that following year. But once you get into regular RMD mode, the important thing to remember is you have to take your second and subsequent RMDs by December 31st of each year. So let's look at an example of that first RMD just to illustrate what those rules mean and how they'll apply to someone taking their first RMD. So let's look at Sam, who was born on June 30th of 1948, which would make his 70th birthday on June 30th of 2018. Therefore, he turned 70 and a half in that same calendar year of 2018. So Sam's options are he can take his first RMD in 2018 because that's the year he reaches 70 and a half, or he can delay it until April 1st of 2019. So again, that only applies to Sam's first RMD, that he's allowed to delay it until the April 1st of the following year. But of course, as I mentioned, he can also take his first RMD in 2018 because that's the year he reaches 70 and a half. So as we noted that in the last slide, if he does delay that first RMD till April 1st, 2019, he'll have to take 2 RMDs in 2019 because in 2019, his second RMD will be due, regardless of whether or not he delayed his first RMD out to that year or not. So that second RMD will be due by the end of 2019. So it's important to remember that if you capitalize on that exception to delay your first RMD, you're going to end up taking two in the same calendar year. And that may or may not work for you, depending on your personal tax situation and what kind of income you think you'll have in those two different calendar years. So another reason why it's important to look at RMDs in connection with the rest of your financial plan to see what situation applies best for you personally. So when we look at those due dates for taking RMDs, there is an exception related to your company plan. And it's the exception that applies to someone who's still working. So if you have a 401k plan or other type of qualified plan and you're still working, you can delay the RMD from that plan if you're still working when you turn 70 and a half. So here you are, you get to a point where you reach the calendar year that you turn 70 and a half, you're still working, you have an active 401k plan or other qualified plan at work. You don't have to take an RMD from that plan when you turn 70 and a half if you're still working. Now, the retirement plan must allow for that exception. Many of them do, but it's important to know whether or not your plan allows for that. And you must not own more than 5% of the company in order to be able to do this. If you do own 5%, more than 5% of the company, then this exception won't apply and you will have to take your RMD. So when do RMDs begin if you are still working and you turn 70 and a half? Well, they'll begin in the year that you separate from service. So maybe you've worked till age 72 and you retire in November of that year. Well, that year that you separate from service, an RMD will be due from your retirement plan that year. Important to note, though, that this exception does not apply to IRAs. So we talked about IRAs, SEP IRAs, simple IRAs. So if you're still working and you have a 401k that you don't have to take an RMD from, but you also have IRAs on the side as other accounts that you have, you still would have to take RMDs from those IRAs under the regular rules that we just talked about a couple minutes ago. Now, that also applies to if you have 401ks or other qualified plans that are still just kind of lingering around from a prior employer. In those cases, you would also have to take an RMD from those qualified plans of a prior employer. So it's only the retirement plan of the employer that you're actively working that you can get this one-time exception to push that RMD out until after you separate from service. So you really want to be aware as you're approaching these ages what types of accounts you have and where they are and how these RMDs are going to apply to those different accounts that you have. So a common question that we get is, well, how much do I have to take out of my account once these RMDs begin? And RMDs are calculated by dividing your IRA or retirement plan account balance by a life expectancy factor specified in this table here known as the IRS Uniform Lifetime Table. So your account balance is calculated as of December 31st of the prior calendar year for which the distribution is required to be made. And then you just simply look at this IRS Uniform Lifetime Table and you take your age and then that life expectancy factor. And that life expectancy factor is divided by your prior year-end account balance to determine what your actual RMD is. So I like to boil things down to simple images whenever possible. So here's really the basic formula for arriving at the amount of the RMD each year. It's that prior year account value divided by that uniform lifetime table factor that we saw on the previous slide, and that equals your RMD. So again, I like to use a lot of examples to show how these things work. Let's look at an example of how that RMD calculation would work. So we've got our client Robert here, who's 72 years old. So he's into his RMD age. And his December 31st, 2018 account balance in his IRA was $535,239. So applying what we just learned about that formula, we would look back at that uniform lifetime table that we just saw in the previous slide, and we say, all right, Robert is 72, so that factor is 25.6 in his case. So how do we apply that factor? In looking at his 2019 RMD, it would be taking that prior year-end account balance, dividing it by that lifetime factor that we take from the table, corresponding with his age, which in this case is 25.6. And then that gives us his 2019 RMD of $20,907.77. Now, Robert can take that RMD at any point in time in 2019, and he can take it in various ways. He can wait until the end of 2019, take it as a lump sum. He can divide that by 12 and just take it monthly because that's helping to provide retirement income, or he can take it quarterly. The IRS really doesn't manage that part of it. They just say that by the end of 2019, you have to take out that required minimum distribution. And of course, as we said a few minutes ago, Robert could also always take a little bit more than that. He just has to at least take out that amount. Now, here's another way to look at that uniform lifetime table, because we often get asked about, well, what percentage of the balances of the account is really coming out? You know, people understand that there's this factor that's used and you divide it by the account balance, but you know, sometimes it's hard to really understand, well, what are we really talking about that's going to come out of the account? So I like this table because you'll note that we have that additional column added there as the percentage of the account balance. So you'll see that in Robert's case, when he was 72 years old, that distribution factor was 25.6, which accounted for about 3.91% of the account balance that was taken out. And you can see when you first get started at age 70 and a half, we look at the distribution factor of 27.4, which dividing that out to arrive at your RMD, you're looking at about 3.65% of your account balance in that first year where you start to take RMDs. So as you glance down this table when you advance in age, you can see that the percentage of balance will increase over time. So the percentage that you take out will increase over time, but the dollar amount, of course, is going to vary because different things are going to happen to your accounts over time. You'll get appreciation. Hopefully, if the market cooperates with you, you get some depreciation in your account because, of course, you've been taking money out over time. So each year end, when we look at the year-end account balance and then apply this factor to it, that percentage is what's going to come out. But of course, the actual dollar value is going to vary depending on how your balance has been calculated over time. So what happens when you have multiple retirement accounts? This is a pretty important point to be aware of with RMDs because it's common for people to have multiple accounts, and you want to be aware of how all those will be factored in when we work with our RMDs. So if you have multiple IRAs, you're going to calculate the RMD separately for each IRA that you own. However, the total amount of all the RMDs may be withdrawn from one or more of the IRAs. So let's say you have 3 IRAs. We calculate the RMD for each one. We add that all up, and maybe all of those together, it comes out to, say, $30,000. You can take out the $30,000 out of one IRA. You can take a little bit out of the 2 IRAs that you own, or you can take a little bit out of each of the 3 IRAs that you own in the example that I'm using. So the idea is that you can aggregate the RMDs that you owe and just take it out of one IRA if that's easier for you. But the key point is that adding up all of the RMDs from the accounts that you have and making sure that you at least take out that amount. So one quick note to know that if you happen to own any inherited IRAs, that those are not included with your own IRAs for this purpose of aggregating, as I've been talking about. So what if you also have company plans, such as 401ks? So we talked about how RMDs are required from those accounts as well. So the RMD rules, as we said, also apply to those retirement plans. However, an important thing to be aware of is that the RMDs must be calculated for each one of those workplace retirement plans, and it has to be withdrawn from each one of those plans. So that's a very important point, because as we just talked a minute ago about aggregating the withdrawal from one IRA when you have multiple IRAs, you're not able to do that with company plans. So maybe you have a couple of 401ks hanging around as well as some IRAs. If you have one or even more than one company plan, you have to make sure you calculate the RMD from each one of those company plans, and then that specific RMD has to come out of each one of those company plans. And as we said a couple slides ago, this applies to company plans that have that Roth option, but not Roth IRAs. So an exception here, because it seems like with these sorts of things, there's always exceptions just to make things a little more complicated for all of us. But an exception here when we're talking about company plans is for 403B plans. So RMDs must still be calculated separately for 403B plans, but the total RMDs from all 403B accounts may be taken from just one of the 403B plans. So an important difference there between 401ks and 403B plans. So you'll want to be aware of those rules if you have those different account types. So again, looking at multiple retirement accounts, how do annuities fit into all this? Well, if you have deferred annuities where you have an account balance in those, then the RMD will be calculated according to the account balance in those accounts. And if it's an IRA annuity or 403B annuities, again, you can aggregate those with your other accounts and maybe take the RMD total out of just one of those accounts. So this applies to before you annuitize that or before you start to take an income stream off of the annuity. So if you decide to annuitize that and you're taking lifetime income from the annuity, then the annuity payment itself is your RMD, because that annuity lifetime payment has been calculated to be paid out over your lifetime. So it's sort of the same idea of an RMD. So once you annuitize any of the annuities that you have, then that annuity payment is the RMD. But remember, you'll still have to handle RMDs from any other account types that you have. So that gets into some planning considerations that we want to be mindful of as we talk about RMDs. You know, we've gone over a lot of things here so far and just looking at different account types and the formula for RMDs and the important elements related to the timing of RMDs. But, you know, how do these RMDs fit in with your overall financial plan? You know, it's easy to look at something like an RMD and just say, okay, there's an IRS rule around these RMDs. I have to be aware of that. I have to take this minimum amount out of my IRA. So, you know, when I get to that point, I'll just take the required amount out. I'll pay my taxes, and then off we go. Well, it's not quite that simple, because with many things like this, you want to be aware of how these RMDs apply to the rest of your comprehensive financial plan, just to make sure you're maximizing how these RMDs fit into your overall financial life. And you know, a lot of this is going to apply to looking at tax considerations with RMDs. So, you know, RMDs represent taxable income. So even though you've enjoyed this tax deferral in these types of accounts for many years, when the RMD comes out, that represents taxable income to you that's considered ordinary income. So what that means is taxed the same way as when you were earning wages or when you got a paycheck from work. So when the RMDs come out, there may be a lot of gains in the account, but the taxation on the RMD is not capital gains, it's ordinary income. So you want to be aware of that ordinary income that's coming to you, because it could have an impact on the taxation of Social Security benefits, for example. So those types of benefits are eligible to be taxed, but it depends on the amount of taxable income you have in that year. So taking out an RMD in a year would be taxable income, and that's going to have an application to the level of taxation that is applied to Social Security benefits. It's also going to have an impact to the Medicare Part B premiums. Medicare Part B premiums are driven off of a table where you pay a certain level of Part B premium depending on the level of income that you have in a year. So when those RMDs come out of your IRAs, again, being taxable income, that taxable income is going to have an impact on that Medicare Part B premium. So, delaying your first RMD, like we talked about in that first year, or using the rule of waiting, until April 1st of the following year, or using that exception when you're still working, that may all sound like a great idea, but there are some downsides that you want to consider doing that, and that's mostly related to these tax considerations that we've been talking about. So, planning for RMDs really should start well before you reach 70 and a half, just to make sure that you're accounting for these tax situations. For example, you might retire in your early 60s and you may have several years of lower income prior to starting your RMDs. And that may result in a large jump in your tax rate once you reach that RMD age. So it might be kind of nice in your 60s when you retire, your income has gone down from not earning wages, and you have a little bit of space there where your tax rate has gone down before you have to start taking those RMDs. So one consideration would be doing some Roth conversions, and those can be considered to basically have the effect of smoothing out your taxes over the years. And by converting some money from your IRA prior to your RMD age over to a Roth IRA, you then essentially lower your IRA balance by the time you reach 70 and a half, and your RMDs, and thus your taxable income, could be lower. So it's important to look at planning scenarios before engaging in this strategy, because you're going to want to look at whether those Roth conversions are going to make sense. So you might say, well, geez, David, it sounds like you just said that you want to take distributions from your IRA before you have to take them out, which would mean that you're paying taxes earlier on that money. And that is true. But as I said, the effect of that is converting some of that IRA money over to a Roth IRA, which will again allow that to grow tax deferred. And then by time you reach your RMD age, then your IRA would theoretically be smaller because you've taken some money off and put it over to a Roth IRA. So your RMDs are going to be less as well once you reach that age. And you have the effect of putting money over to a Roth IRA, which, as you'll recall, you don't have to take RMDs from a Roth IRA. So the idea is that you'll pay a little bit more taxes in those years leading up to 70 and a half, but you'll pay less taxes later on from an IRA that has been decreased through this Roth conversion strategy. So not a strategy that's going to make sense in every situation. So important to look at your individual situation and see how those Roth conversions will fit in to your overall financial plan. And, one nice thing that we do for our clients here is, as we're building out the financial plan with the tool that we use for our financial planning, we're able to run scenarios, side by side with your base plan to look at how Roth conversions over one or several years might impact you. So it's a way to look at, if we do these Roth conversions, how will this all play out over time? And then we can actually examine the effect of the tax rate over time by doing this, and really by forecasting your entire financial plan over the rest of your life, we can essentially look at, okay, if we do these Roth conversions, how will this impact my total portfolio over time? Maybe accelerating taxes paid prior to RMD age might make sense over time, because as we look at forecasting out 20, 25, or 30 years, then maybe there's a positive impact to doing that. So again, you want to be aware of your own personal situation before engaging with that Roth conversion strategy. So one last point on that is we'll commonly work with a accountant in this situation too, so that if we're going to take money out of an IRA prior to the RMD age, we'll do it in such a way where we're using up the marginal tax bracket that you're already in, so that we're not taking out more money from the IRA to put you into another tax bracket. We're essentially using a tax bracket that you're already in. So we'll do it in a way that makes sense for the overall strategy. Now, what happens if we don't take an RMD, or we don't take out enough of an RMD? So the IRS has really made a point of making this a high penalty, high pain point for people who don't take out an RMD or don't take their full RMD out. So the penalty for this is fairly steep. And basically, as I said, you can always withdraw more than you're required to from your IRA and your retirement plans. However, if you fail to take at least the RMD for any year, or if you take it too late, you'll be subject to a federal penalty. So this is really not a pleasant situation for you. You'll end up having to still take the RMD that you missed, and on top of that, you pay a penalty of 50% on the amount that you did not take out. So essentially on the amount of which the RMD exceeded the distributions that were actually made to you during the year. And you're also taxed on that penalty amount that comes out as well. So you'll still have to take your full RMD. You'll have to pay a 50% penalty on the amount that you were short, and that amount that comes out to represent the penalty is also taxable to you. So this is a real costly mistake, and just want to make sure that you're avoiding that from happening. And it's not likely that this sort of thing happens to someone that has one IRA and you just simply calculate the RMD and you take that amount out. We have a great system here at Stonehearth where we calculate those RMDs at the beginning of the year, and we let our clients know exactly what that amount is. But where we see sometimes folks can get into some trouble here is, working with situations that we described previously, where you may have multiple accounts or you have IRAs plus 401ks, and there's a little confusion about, taking the RMD from the right account versus being able to aggregate the withdrawals from one account. So when you have multiple accounts, that's when it's important to be aware of all the moving parts so that you don't get hit with this penalty. Now, there are certain circumstances with this penalty that you can dictate to the IRS how and why the mistake happened, and the IRS can and actually often does eliminate the penalty. So you have to file Form 5329 for each year that you had an RMD missed or there was a shortfall in the amount that you took, and you can attach a statement to the IRS providing, as they indicate, reasonable cause. So if you kind of just tell your story that it was an administrative mistake or some sort of oversight, the IRS has proven over time to be fairly lenient in waiving this penalty. But of course, the penalty is steep enough where the best course of action is just to avoid it in the first place. So let's spend a minute just talking about inherited IRAs and retirement plans. To this point, all of the rules that we've talked about are related to original accounts that you yourself own and how those RMDs apply in those situations. But there's also RMDs that apply to people who inherit these accounts that RMDs apply to. So let's say a spouse inherits an IRA or a retirement plan. The nice thing about a spouse inheriting one of these plans is that the spouse is allowed to roll those assets into an IRA in their own name, and then the rest of the RMD rules that we've been talking about will apply to that individual. So, for example, let's say two spouses are both age 65. One spouse passes away with an IRA. That surviving spouse can inherit that IRA and just simply take it on as their own. If they already have an IRA, then that surviving spouse can just roll those assets into an IRA they already have. If they happen to not have an IRA, they can open an IRA and roll those inherited assets into their own IRA. But the important point is, because it's now considered that surviving spouse's own IRA, then they can then wait until their own age 70 and a half and apply all those same RMD rules that we've already talked about. If they happen to inherit a 401k or other type of workplace plan, then they can do the same thing, roll those assets into their own IRA, and then off they go with the regular RMD rules that would apply. Now, what about a non-spouse beneficiary? So maybe you're someone that's inherited an IRA from one of your parents. So in this case, the rules are slightly more complex. It'll depend on when that original account owner died, meaning that did they pass away before or after their RMD age. That has some application to the rules that will be put in place in this situation. But generally, it allows the beneficiary to take those RMDs over their remaining life expectancy. So what will happen there is that individual will now have a inherited IRA, and it's noted as an inherited IRA because it's treated differently as their own IRA. And in that case, with the inherited IRA, you will have to start taking RMDs regardless of your age. So maybe you inherit an IRA from one of your parents and you're only 45 years old. Well, you have to start taking RMDs at that point, and they're calculated to be taken out over your remaining life expectancy. So the factor that's used is a little bit different than when you start to take RMDs out of your own plan that we looked at with the other table. One note here is I talked about how spouses can inherit an IRA and then make it their own IRA so they can wait till 70 and a half. One note is that if a spouse is younger than 59 and a half and they inherit an IRA and they need to start accessing that money, they actually might want to not roll it into their own IRA, because then if they take money out prior to age 59 and a half, they'd be subject to penalties. But if they take it on as a inherited IRA, like a non-spouse beneficiary would that we just talked about, then they actually could start to access that money at a younger age and take out the RMDs. So you'll want to be aware of the rules that apply in situations where you inherit an IRA or a retirement plan. So let's move over to something called a QCD, or a qualified charitable distribution. These have been around for a few years, but some of the lifespan of these QCDs has been such that they were put in place a few years ago, and there's been some changes to them over time. But qualified charitable distributions are in effect right now, and what they are is a direct transfer of funds from an IRA to a qualified charity. So a benefit of QCDs is that they can be counted towards your RMD for the year, which is why we're talking about them within this context of the RMD framework, provided that certain requirements are met. So you don't receive a charitable deduction when you do a QCD. However, an additional benefit of these is that the amount donated directly to the charity is excluded from taxable income. So a couple points to be aware of here. So remember, we've been talking this whole time about how distributions from an IRA or a qualified plan that represent your RMD, those are taxable income to you. So if you engage in a qualified charitable distribution, you're able to count that money towards your RMD for the year, but you're not taxed on it. So you don't get that charitable deduction that you would when you normally make a contribution to charity. But in this case, the QCD is not counted to you as income. So furthermore, using a QCD does not require that you itemize your deduction, so making it possible to use the now higher standard deduction that we see with the new tax rules while still using a QCD to donate to charity. So the recent tax law changes that will likely have many more taxpayers using the standard deduction instead of itemizing your deductions, could bring some increased appeal to these QCDs, since regular charitable deductions require that you itemize your deductions on Schedule A under current tax laws. So with less people itemizing deductions and less people using Schedule A, you're not getting that charitable deduction that you normally would. So a QCD does not require that you itemize your deductions. So to make a qualified charitable distribution, you have to be 70 and a half or older, and an individual can contribute up to $100,000 per year in a QCD. Now, for married couples, each spouse can make a qualified charitable distribution up to the $100,000 limit, so for a total of $200,000. And if a spouse does it, it would have to come out of their own IRA. So the $100,000 per person limit applies to the sum of all QCDs taken from all IRAs in a year. So there may be a circumstance where you do this across multiple accounts, but the $100,000 would be your total amount of QCDs that you make, even if you're doing it from multiple accounts. So a donor can make one large contribution or several smaller contributions over the course of the calendar year. And QCDs can be made from a traditional IRA or a inherited IRA or inactive SEP and simple IRAs. So inactive SEP and simple IRAs are accounts that are no longer receiving employer contributions in the year that you make the QCD. Now, an important point here is that the charity must be a 501c3 organization eligible to receive tax-deductible contributions. And also important to note that under current tax law, private foundations and donor advised funds do not qualify for QCD. So, making a donation to a regular charity that you can think of, American Red Cross, things like that, then you can make a QCD to that type of charity and have it fall within the rules. But you cannot make a QCD to a private foundation or donor advised fund. And you don't have to make a QCD for your entire RMD for the year. Maybe you have an RMD of $40,000, but you use a QCD for $20,000 of that, and then you take the other $20,000 as a regular RMD to you. In this case, the $20,000 that applies to the QCD would not represent taxable income to you. It gets represented on your tax return as a QCD, but that other $20,000 that you took out to satisfy your full RMD that just came to you, that would be taxable income. So you can kind of split up your RMD to have part of it go to a QCD and then part of it be a regular RMD. So as we wrap up here, you can see that there's a lot of moving parts here related to RMDs. It's a fairly well-known rule that most people are aware of, but as you can see from the items that we talked about today, there's enough detail there and nuances to the rules that you really want to be talking to someone about, being aware of the the rules and some of the planning opportunities around RMDs. So I kind of boil it down to, two things to be aware of is, well, let's make sure we satisfy all the rules and start the RMDs at the right time and take them at the right time and make sure we calculate the right amount. So that's the first part. But the second part is, as we touched on today, all of the elements related to financial planning with RMDs and understanding how these fit in with your overall comprehensive financial plan. And we're happy to help with that and see where the RMDs fit in with your overall plan. So with that, I'll conclude what I wanted to talk about here today related to RMDs. And if we have any questions, we have some time to take a look at some questions.
Hi, David. Thanks so much. Just a reminder to everybody, there is a question section on your GoToMeeting toolbar. You can go ahead and submit your questions there, and I will see them. We're going to try and get to all of them today, but we do have a couple here, so I'll get started. David, the first one is, if my birthday is in July, so I will turn 70 and a half in January of 2020, do I have to take the first RMD by April 1st of 2020 or April 1st of 2021?
Yeah, that's a good question. Sometimes people look at the point in which they reach 70 and a half being prior to April 1st. So it's, well, wait a second, do I take my first RMD in that year or the year after? So in this case, you turn 70 and a half in January of 2020. So really, you can actually wait till April 1st of 2021 to take your first RMD. But of course, you can take that first RMD in 2020 because that's the year you turn 70 and a half. And in this case, if you wait till April 1st of 2021, then you'd have to take 2 RMDs in that year because you delayed your first one. But that's a good question.
The next one I have is, do I have to wait until after I actually turn 70 and a half to take my first RMD, or can I take the RMD out at any time during the year that I turn 70 and a half?
Yeah, that's an important point too. Some people look at it and say, okay, my RMDs start when I turn 70 and a half. So if I turn 70 and a half in August of a year, do I have to actually wait until that point in August and then take my RMD? And the answer is no. So the RMD, that first RMD, you can take in any time in the calendar year that you turn 70 and a half. So even if you don't turn 70 and a half until very late in the year, and you do want to take your first RMD in that first year, you don't want to push it off until April 1st of the following year, you can take the RMD at any time during that calendar year that you turn 70 and a half, including prior to the actual day that you turn 70 and a half.
Looks like we just have one more. It is, can I roll my required minimum distribution from an IRA into a Roth IRA if I'm willing to pay taxes on the conversion?
Yeah, that's a good question as it relates to what I talked about a few minutes ago related to these Roth conversions to help with tax situations. So the answer is no. You're not able to do that. You have to actually receive your RMD actually as a taxable distribution to you. Now, after satisfying your RMD, you can take additional withdrawals from an IRA over and then convert those over to a Roth. But most of the time, those Roth conversions are being done prior to reaching the RMD age. But once you reach RMD age, you have to at least take that RMD as a taxable distribution to you. And after you satisfy that, you can convert some IRA money over to a Roth, which will also be taxable income as well.
All right, I think that's it for all of the questions. I just want to remind everybody, we do host these webinars every month. At the end of every month, David, I believe you are doing the webinar for March. Remind me again, I think that is asset protection from nursing home.
Yes,
is that correct? Yeah. So nursing home protection, which will be in March. You can find all of that information on our website. Please feel free to go ahead and log on there, register for that webinar, or you can also find all of our white papers, including the one that David wrote today on required minimum distributions from our drop-down menu. It's resources and then white papers, and you can go ahead and download that. So David, thank you so much for all of this information. We hope that you all have a wonderful day, and we'll talk to you all soon.
Thank you. So long.